Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our series on the set of videos on reading the financial statements 3 of 7 income statement. Hope you will like, share and special request to all to don't forget to subscribe our channel. Series on reading the financial statements 3 of 7 income statement. Reading the financial statement, income statement. The income statement shows the operating results of a company for a given period. It matches revenues from sales against the cost of making those sales to arrive at a net income or loss in that case. The first portion of the income statement is the revenue section. This section shows the sales of the company less the cost of the goods sold, that is COGS, to arrive at a gross profit. The gross profit is the profit obtained from the sales without considering the operating expenses of the company. The next section of the income statement includes the operating expenses of the company such as salaries, rent, utilities, advertising, interest charges, and other expenses associated with running a company. Often the operating expenses are not as detailed as shown on the accompanying income statement for RSC. Many companies will just list the operating expenses as selling, general and administrative or SGA expenses. Subtracting the operating expenses from the gross profits gives us the operating income of the company. Non-operating items are next and includes dividends and interest income received, interest expenses and other non-operating related income, which then yields the incomes before taxes, and this is called as a PBT, that's profit before tax. After subtracting taxes, we are left with the net income or loss of the company, and also called as PAT, that is profit after tax. Sales. Revenue generated from making sales of the company's products is the source of sales. Some companies will break out into several categories with the most important revenue source shown first, etc. Our fictitious company RS is in retail sales, so we can expect that they will experience some returns of the products sold. The company prepares for returns financially by including a line item on the income statement called less allowance for returns. The returns amount is typically based on the prior experience of the company. There may also be a separate line item for discounts on merchandise and price reductions. After considering the impact of returns, price reductions, and discounts, the company is left with net sales. Cost of goods sold, or simply COGS. The cost of goods sold is the direct cost of the merchandise that RC sold during the year. If the company is a retail company, they buy finished goods such as washing machine, refrigerators, microwave, etc. for resale. The cost of goods sold includes the cost of the merchandise, shipping cost, and other costs directly attributable to the merchandise that was sold during the period. If the company is a manufacturing company, then the cost of goods sold would include raw material costs, manufacturing labor, and other directly related manufacturing costs. Gross profit. Gross profit is the net sales minus the cost of the goods sold, that's COGS, and is an important term in considering the financial health of a company. Operating expenses. Expenses that are not directly related to the cost of the merchandise sold are grouped under operating expenses. Many companies just label this category selling, general and administrative, that's simply SGA. As you can see, sometimes the companies the operating expenses includes wages and salaries, advertising, utilities, rents, and other administrative costs. As depreciation is recognized on the balance sheet, it becomes an expense item that's cost on the income statement. A company may elect to use either an operating lease or a capital lease as needed to meet the financial needs of the company. However, to qualify as capital lease, the lease must be meeting the following four criteria. The title is transferred to the lessee by the end of the lease term. A relatively inexpensive purchase option is available at the end of the lease term. The lease term must extend for at least 75% or more of the useful life of the asset. At the start of the lease, the present value of the lease payments must be 90% or more of the property's fair market value. Total operating income. Total operating income is found by subtracting the operating expenses from the gross profit of the company. Other income statement items. After operating expenses, about all that is left to cover are some non-operating income and expenses items of the company and taxes. The company has some investments that generate income in the form of dividends and interest. Net income. Finally, we arrive at the bottom line, which is net income. Net income is the income of the company after we consider all the expenses the company incurred during the income statement period. If the company had lost money during the year, the net income would be negative and would be shown in parentheses. In addition to net income, another term, comprehensive income, is beginning to appear on income statements. Comprehensive income is a relatively new term that takes into account unusual events such as foreign currency adjustments, pension liability adjustments, and certain investment transactions. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel. Accounts and Finance with FARSK. Thank you.